Yeah, hello, welcome to a new video. In our last video, we looked at opening a demo account, an MT4 demo account to trade with. And so by now you should know how to do that. And for mobile users, you can do that by going to YouTube. Okay, you go to YouTube, you can search how, yes, so when you go to YouTube, just search create mobile MT4 demo, and there are a lot of videos there for you to watch so that you too can create a demo account on your mobile device, because you need the MT4 to be able to follow through with our discussion in this video. Now, once you have your MT4 account, what is next is being able to at least set it up, because normally when you download, you have it like this. But you can add some of the instruments. You see there, you have Euro USD, USD JPY. You might not want to trade this, you might want to trade something else. And so first, let's learn how to add some instruments and also to set up our MT4 the way we want it. Then we'll go into the discussion. Normally, I would just close everything and I'll begin to add new stuff. The first thing I do is I right click this window called the market watch. You can see it, the market watch window. Then I go to show all. When you click show all, it displays all the list instruments you can trade with this broker. Yeah, so you can either, then we can begin to add the instruments to the platform. So you can either do a click and drag, then you get it here. That's an option. Or you can right click on the instrument and click on chart window. Then you can see that the GBP USD also has been added. So let's add a third one. Let's right click and add chart window. Yeah, so now we have about 3 of these instruments added. Now, when you add the instruments, you see how it is. It is this ugly green and black screen, but you can begin to change it to suit the way you want it. So first and foremost, let's look at where my mouse is. There are 3 things there. You have what we call the line chart, the candlesticks chart, and the bar chart. Now it is okay. Let's magnify it. You see that this is the bar chart. Okay, you can change that to a line chart if you like to, or a candlestick chart. But we will be using the candlestick chart to do our analysis in the preceding videos. So we'll stick to the candlestick chart. Yes. Now, after having it this way, you can right click on our screen, go to properties. Then we can change the way it looks. You can change our background to any color we want to. Yes, you can change anything you want. Let's say this color. That will be our background. Then we have foreground. You can make it black or blue. Let's say black. Then the grid. The grid is these checkered boxes on it. Normally, I take it away. I don't really bother myself with the grid. So we have bar up. I like it like this. Then bar down, I make it red or fire break. Where is fire break? Okay, fire break, yes. Then my bull candle is normally green. Then bear candle is red. Then line graph, I like it to be black. So the ask line, you can make it green. Anything you want. So, and when you click OK, the settings have been made. You can see that it is changed. I don't like the grid, so I can go back to properties. Then this time go to common. Then I take off the show grid. Then now this is how our chart looks like. Now, once you have done this, you can save what you have done. You go to template, then you go to save template. Then you can give it a name. You can call it FX, any name you want it. Yes. So that it has been saved. So then if you want to have the same thing on your other charts, once you click on the chart, you right click on the screen, then go to load template. Then you go to FX. Then now you double click and now you see it there. You can also have it on the USD JPY. You go to load template. Then you can also click on it and click open to get it. Yeah. So that is our chart. Let's stay on the Euro USD chart. There's another something that I want. Normally I want, let me see, the period separators. So I'll take that and we have the period separators. Yeah, so I can save the template again so that it will affect. I can load it on the other one. So save it. I'll use the same name. Or you can change it if you like to. Yes. So that is that. Now, after doing all these settings, we can come back here. When we come to this window, you can clearly see that this is a demo account, Ion FX Demo 1. Then the name is there. Then when you place your mouse on it, you can see the balance and the something there. Let me place my mouse on it again. You see 1:500. That is called your leverage. It's called your leverage. But I'll come to that. So now that our platform is set, we can begin to go through the things we want to learn today. Now, we are going through Forex Informationals. That is using the MT4 platform to explain basic terminologies in Forex. Already we know what Forex is. Forex is trading currencies. So we can have the dollar against the euro or the pound against the yen. So that is that. So who trades Forex? Anyone can trade Forex. It could be an institution like a bank, an insurance company, a hedge fund. Anyone can trade Forex. And how do we trade Forex? Well, we trade Forex just like in any market. We buy low and we sell high. So in Forex too, there's this common terminology. We say that buy the dips and sell the rallies. So that is that. Just think about you going to buy something to resell. Let's say you want to buy a smartphone, you want to resell. When you go into the market, you want a smartphone that is quite cheap so that when you can add your profit and sell. So Forex works like that. Why do people trade Forex? People trade Forex because of the fact that Forex is opened 24 hours a day, 5 days in the week. Actually, it opens on Sunday night. In my country, it's Sunday night in Ghana, but in the US, it will be 5 p.m. Eastern time in New York. So the market opens at that time and closes on Friday, 5 p.m. Eastern time. So that is the times the forex market open. And because of the flexibility, people like to trade because even if the person works a day job, the person can say, okay, fine, I have time to trade in the evenings. So after work, you come and sit on his computer or look at his smartphone and trade. That's one reason people trade for it. Another reason is because Forex has low cost in terms of the transactions. In other markets, the cost of transaction or the cost of trading is a little high in terms of the commissions that is charged. But in Forex, it's either only the pips. The difference between the ask and the bid price is called the spread. It's not the pips, it's actually the spread. Or sometimes to some brokers charge commissions. It could be either commissions or the spreads or both, but it's usually cheaper. Sometimes with currencies like Euro USD, you can get as low as 1 pip of spread, and that could be just $1 or less for the type of trade or the type of volume you have on your trade. Then another reason why people like Forex is because of the low capital. In some markets, like maybe the stock market, you might have to start with around $2,000 or more. But in the Forex market, with about $100, you can start trading. Even some brokers now, because of competition, even can give you an account for just $25. So you can start with $25. That's I wouldn't advise you to start with that. It's too small. At least you should start with around 200 or at least $100. It's okay. Yeah. So we are come to look at the other terminologies like the pips, spread, the bull market, bear market, candlestick, time frames, leverage, lot size, instruments, currency pair. I've already talked about the pips. Yes, the pips. I mentioned it earlier on. But for us to understand what pips is, we should understand something. Most of the currency pairs have a 4 decimal point structure, or it's called an ISO, International Standard Organization. For Euro USD, most of the currencies, it has a 4 decimal point place. Yeah. So for example, let's see the price of Euro USD right now. It is 1.1401. Please, the last three there is called a pipette. Some brokers give that, but the most important ones are the 4 digits behind the one. So 1.1401. 1.1401. That is the price now. So if let me even explain what pips is. The pips is the unit measurement to express the change in value between two currencies. It is the unit measurement to express the change. Basically, I say it is a way to measure the movement of the market. It is a measure of the movement of the market between currency pairs. Yes, so now you have Euro USD at 1.1401. If it goes up about 10 pips, it will become the last two decades will change. It will move from 0.1. If it's going up 10 pips, it's going to 0.1, 0.2, 0.3, 0.4, 0.5, 0.6, 0.7, 0.8, 0.9, then 1.0, then 1.1. So it becomes 1 point. So if it moves up 10 pips, it becomes 1.1411. Yeah. And it moves down 10 pips from that one to become 1.1. So 4 minus 10. Let's say it moves down about 2 pips. So it will become 1.1439. 1.1439. But please, you don't have to manually calculate all these things. And this is the pips for the 4-decade currencies. There's also the 2-decade currencies. Normally, the yen pairs have 2 decimal places. So let's see the value of the USD yen right now. It is 113.89. So 113.89. So if it goes up 10 pips, it becomes 113.99. If it goes down 10 pips, it becomes 113.79. So basically, this is how it is. 1 pip of the yen pair will be like this, and the 1 pip of the Euro USD pairs will be like this. Basically, this is how they look like. But you don't have to do all these calculations manually. There's a tool that allows you to measure the pips easily. And this is the tool. It's called the crosshair, as you can see on the screen. The crosshair. So once you pick the tool, you can measure it. And it tells you the number of pips the market has moved. In this case, we have about 105 pips. You can also measure here the movement here, about 73 pips. So you don't need to make or do any manual calculation for this. The next one is spread. The spread is basically the difference between the ask and the bid price, or the sell and the buy. So in this case, we have 11389, 11390, means that the spread between these guys is just about 1. Yeah, so that is that. That is the spread. Then we have bull market and bear market. In Forex, when prices are going up, from the bottom going up, we say the market is bullish. So then that will be a bull market. Then when the prices are coming down, like here, we say the market is bearish. Yes. So we also have these things. These red and green things are called candlesticks. I've already mentioned them to you. It used to be all green, and I was able to change it into this. So we have bull candles and bear candles. Now, anything green you see is a bull candle or bullish candle, and anything red on the screen is a bear candle. Or you can also say that it's a buy candle. So, and all the green candles show buyer activity, and all the sell candles show seller activity or the activity of sellers. Yes, so let's continue. Yes, I've already talked about candlesticks. So time frames. Well, on the chart, we have several time frames. You can see that we have M1, M5, M15, M30, H1, H4, D1, W1. And so what do they mean? M1 simply means 1 minute. So let me go to the 1 minute chart. When you go there, basically each bar you see, whether green or red, is a 1 minute bar. It means it forms within 1 minute. It forms within 1 minute. So in the same, when you go to 5 minutes, all these bars form within 5 minutes. In later videos, we'll talk more about candlesticks. So it's the same for 15 minutes, 30 minutes. Then we go to 1 hour, 4 hour. Then each one is the 1 hour chart. H4 is the 4 hour chart. D1 is the daily chart. And W1 is the weekly chart. You can see USD weekly. Then daily, you see USD daily. Then USD H4, which means the 4 hour. Then we also have the MN is monthly, USD monthly. So that is that, meaning that all these candles formed within a month. So like we can put the crosshair on it and you can see the time it started forming. Come below the screen and you see it. Yes, and please let me mention something. The chart we see here, on the chart, we see that we have time below it. It's a chart between time and price. So we have time below the screen, then we have price on the right of the screen. So you see, when we go to monthly, we see only 1 month one. So 1st May to 1st May 2006 to 1st January. So it's more like a 1 year something. And when we drop down to lower charts, you see the time frames will change. Okay, like the daily, you see 12 October, 3rd November, then in that order. So it's a chart of a chart where we have time beneath, then price on the right. Yeah, so that is that. And let me also mention that the time frame also determines the type of trader a person is. Some people want quick results, and so they want to trade on a shorter time frame. But some also can stay and wait for longer time for their trade to evolve. And so if you are trading on the daily, perhaps if you got in here, it will take you some time. Let's check the date. If let's say you were able to buy this around here, 26, that is November 9th, and you were able to wait till it came here, that is 15th December. So it is about a month-long trade. Some people can do that. Some people can even stay in a trade for a year. But some people also can't do that. They can only stay in a trade for a day or two. And they are also very short-term traders. And the very short-term traders, we call them the scalpers. Scalper. Let me type that. Scalper. Like this. Then we have the intraday trader. The intraday, the scalper will come into the market, go for very fast pips, maybe 10, 15, sometimes 5 pips, 10, 15 pips. The person has gotten enough and then you wait for another opportunity to go for 10, 15 pips. The intraday guy wants to know the direction of the market for the day. Sorry, the direction of the market for the day. And so let's say maybe that guy says, okay, fine, I'll be trading on the 1 hour. And you realize that at this time, the market was going up. And so he says, okay, fine, let me just get in the trend of the day. So that is the intraday. So you can come to trade during the landing session, then wait for the day to close, and he will also close his trade. So that's the intraday type of trader. We also have the swing trader. The swing trader. Swing traders could be trading on either the 4 hour or the daily. So they look for the swings. They can be here and wait for this swing to complete. Then they will buy this swing. And when the price gets here, they will be selling that swing too. So that is the swing trader. Then we have the position trader. Position trader. The position trader will usually stay in a position. For example, can stay in this position as long as the market is going in his favor. He will stay in it. Let's see, this was 2012 September. So, and let me check the apex of the chart here, the topmost point the market reached. That was in 2015. So, as long as the market is going in his favor, even if it will take him 10 years, he will stay in it and milk the pips. So he's called the position trader. And the time frames allow all different types of traders to trade based on their the way the kind of result they want, whether they want fast results or they can wait for a long-term results. All right. We are done with time frames. Now leverage. Anytime you go to a broker, especially when you are opening your account, they have different type of leverages. They have 20 is to 1, 50 is to 1, 100 is to 1, 200 is to 1, 500 is to 1, and 1000 is to 1. And some even have 1000 is to 1. What this means basically is that whatever amount you have, let's say when you take 20 is to 1, it means that each dollar is worth $20 for you. The broker allows you to be able to command 20 times the money you have deposited. So let's say you went for a broker who gave you 100 is to 1, meaning that every $1 is worth $100. So let's say you deposited $1,000. Okay, so 1,000 times 100 would be 100,000. So in effect, leverage allows you to command a bigger amount of money. So your $1,000 will be worth 100,000. That's what leverage does for you. But there's a good side and bad side. If you know what you are doing when you are trading, if you know what you do when you trade, then leverage is okay. It will allow you to make a lot of money. But if you don't know what you are doing, it will let you to lose money fast, especially when you go for you increase what we call your loss size. We come to loss size right now. So that is leverage. It goes with loss size. Now, before you take a trade, you come to the other screen, this one. Then these values are there. We call them the lot sizes or the volume. 0.1 means that, no, let me start from 0.01. 0.01 means that, let me, 0.01 means that every pip the market moves is worth 10 cents. So that will be 20 cents, 30 cents, 40 cents, 50 cents. Well, there's from 0.01, which is usually called a micro. You go to 0.1 or 0.10. 0.10, it means that on the average, every pip it will be worth $1. Then we have 1.0. It means every pip will be worth about $10. Then we have 10. Every pip will be worth 100. In 100 lots, every pip will be worth about $1,000. But you can use the volume you apply on your trade will be dependent on both the leverage and amount of money you have deposited. All right, let's continue. We have instruments. What we trade in the forex market is called instruments. In fact, in the capital markets, whether you are trading stocks or currencies or commodities, all of these are called instruments. Even for this chart, apart from currencies, there are also stocks listed. Let me expand this. So all these are instruments. You can see CAD, CHF, AED, CHF, USD, SGD is the Singaporean dollar, USD NOK, that's Norwegian krona. So all these are instruments that you can trade. You see a lot of them. And we come to the metals, which is the silver, gold. You can trade all of them here. Then we have some indices here, the JP225, JP22. All these are, indices. They are all instruments you can trade. Okay. I think even it allows you to trade the futures market also. Then you see rice, soya bean, corn, all of these are listed. Coffee. They are commodities. Copper. You can even trade oil, crude oil. So let's say you are saying, oh, in my country, they are extracting a lot of gold, but I'm not benefiting from it. No problem. You can come into the market and trade gold and make your money. And you see, when you know how to trade, whether the prices are going up or going down, you don't care because you can be a buyer or a seller at any time. It is based on your knowledge and understanding of the market. Okay, yeah. So all these are instruments listed. That is Brent. Then we have the stocks. We have stocks. Like yeah, you see IBM is here. Microsoft, MSFT is Microsoft. So G is I think General Electric also, General Motors or something. So all these guys are here. AIG, Visa, PepsiCo, Nike, Colgate, all these are stocks. Even Snapchat is wow. I never knew this. That Snapchat has been listed here. Wow. Yeah, see, that is Yahoo. That FB is Facebook. You can trade it. People trade Facebook stocks. You can trade Google and all that. So, but I only trade currencies and sometimes commodities. So I limit myself to that. So those are the instruments listed for us to trade. Then what else? We have currency and currency pair. I think these are quite simpler. Currency, normally when you are talking about currency, you're talking about USD for United States dollar, GBP, Great Britain, pound, in that order. So these are currencies, and a currency pair is when you have GBP, that's the Great British pound, paired with the USD, something like this. No, and let me quickly go through the major pairs. Well, the major pairs are the ones with United States dollar in them. So we have Euro with USD, we have GBP with USD, we have AUD, this is the Australian dollar with USD. Then we have the NZD, that's the New Zealand dollar with United States dollar. Then we have the yen with the United States dollar, but that is written this way, USD JPY. It is not JPY USD, it is USD JPY. Then we also have the card that is written USD card. Then finally you have USD CHF. So these are the majors. These guys are the majors. Yeah, call them the majors. So take note of how they are written down. Okay. You can go to babypips.com and learn more about these things. All right. The video is already running long, so we would end here and continue in another video. So stay tuned. Bye bye.